So there are two things that people are seeking today that are difficult for them to achieve. One is non-correlation. Most people's portfolios are made up of equity and fixed income, and these are both very liquid, very traded securities. And the equity market, as you know, and the fixed income market go up and down. One of the things that non-traded REITs can provide is lower correlation to both the equity markets and the fixed income markets.
The reason I think you may not want to invest in a traded BDC is simply the volatility. There's very good traded BDCs out there, but what you've seen in early 2016, when there's a fear factor in the market, what you saw when the high yield bonds traded off, typically the traded BDCs trade correlation with the high yield bonds. And when that traded off, you saw an overselling in traded BDCs, which hasn't recovered. I think the average traded BDC trades at a 15% discount to book. So if you bought a traded BDC a year ago, you've lost 15-20% of your value in a lot of these BDCs. The loans that we invest in are illiquid. It makes a lot of sense to have an illiquid structure, invest in long-term illiquid assets.
It's an opportunity for retail investors as well as entities other than individuals to invest in professional real estate, various asset classes, whether it's office, retail, multifamily.
Something's called the illiquidity premium exists, and that illiquidity premium, which can be 300 to 500 basis points depending on the situation, ultimately is what contributes and creates the opportunity for a yield that today in the traded BDC and in the non-traded is based on sort of NAV or the offering prices in a 9 to 10% range.
Non-traded REITs can create income, can focus on creating income, and that is something that today in a very low interest rate environment can be very compelling to both advisors and investors looking to create more income for their investors.